morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, it's the week before Carnival, and of course, we're all getting caught up with our party plans for the upcoming week and indeed the major festival on Monday and Tuesday of next week. But today, we're taking a look at some results from the banking sector of the Trinidad and Tobago Stock Exchange. We're looking at First Citizens Group Financial Holdings, or FCGFH. Let's call them First for the time being, as well as NCB Financial Group, or NCBFG. Now, both groups would have reported diverging results. Let's take a look at what would have happened for the fiscal years ended September 30th, 2023, and what investors might expect for each of those groups in the coming months ahead. Turning firstly to First, the group would have recorded an earnings per share figure, or reported an earnings per share figure of $3.08, which was a 5.8% improvement from the $2.91 per share recorded in the prior fiscal 2022 period. Net interest income was up an impressive 24.5% from 1.5 odd billion to just about 1.85 billion. Overall total net revenue was up 15.6 billion from 2.1 to 2.47 billion. There was some deterioration in terms of credit impairment losses, moving from a write back of 17.3 million to 56.2 million losses in the most recently concluded fiscal period. However, overall profits after tax improved from that 5.9 odd percent from 733 million to just under 780 odd million. When we take a look at the segment performance from a profit before tax perspective for FCGFH, or First, we can see that it was generally good reading for investors. When we look, for example, at its corporate banking segment in that light blue, it was up just around 17% year on year from 581 to 680 million. Its treasury and investment banking segment, in fact, increased a whopping 60% from 406 to 655 million. The trustee and asset management division did have a modest decline from 56 to 52 million in that green segment, and retail banking also dipped a bit from 309 million to just about 285 million in the most recently concluded period. Now, at a price of $50.03, First is trading at a price earnings ratio of 16.22 times, just above that banking sector average of 14.7 times, and does offer a fairly generous dividend yield of 4%, which is modestly above the banking sector average of 3.6%. So with increased operating profits in mind, keeping an eye on those credit impairment losses, relatively elevated valuations, but a healthy dividend yield, on the balance of all those factors, Bourse is maintaining a market weight rating on First Citizens Group Financial Holdings for the time being. Turning quickly to NCBFG, or NCB Financial Group. Well, for the fiscal year 2023, the group recorded an earnings per share figure in TT dollar equivalent of around 14 cents, which is a 68% decline from the fiscal 2022 period of 45 cents. Now, overall net results from banking and investment activities, in fact, increased 5.3% from 4.7 odd billion TT equivalent to just over 4.9 billion TT equivalent. Overall, however, net operating income declined 5.5 odd percent from 6.3 billion TT equivalent to just under 6 billion TT equivalent. And this was really attributable to that net result from insurance activities, which we'll speak about shortly. Operating expenses increased significantly from 4.6 to 5.1 billion TT equivalent, and over 11% increase, and that would have contributed to that 68% decline in net profit attributable to equity holders from just over 1 billion TT equivalent in fiscal 2022 to just over 330 million TT equivalent in fiscal 2023. Looking at the net operating income by segment for NCBFG, we can see some improvements generally in most of its non-insurance related areas. Net interest income, for example, was up 6%, even in a higher interest rate environment, moving from 2.6 odd billion to 2.7 billion TT equivalent. Net fee and commission income also up 7.5 odd percent from 1.13 billion to just over 1.2 billion. And gains on FX and investment activities increased just around 30% from 723 to just about 940 odd million TT equivalent. Of course, that net result from insurance activities would have been a significant weight on the overall operating income, moving from 1.6 billion TT equivalent to just over 1 billion TT equivalent. And again, much of this would have been affected by some of its investments in GHL, as well as the fact that there was significant accounting changes over the past couple of months, which would have changed how the insurance activities are reported. So, of course, we'll be looking forward in subsequent periods to see how that pans out in terms of comparability over multiple periods. For the time being, though, it would have led to some diminution in the group's earnings per share. Again, for fiscal 2023, 14 cents, one of the lowest or the lowest level in the past 5 fiscal years for NCBFG, leading to an elevated price earnings ratio of around 23.5 times, not the highest in the past 5 years, but of course there would have been significant price adjustments for NCBFG over the past few years. Now, when we take a look at a different valuation metric, perhaps the price to book ratio, we can see that NCB has maintained and in fact modestly grown its book value per share over the past 5 fiscal periods, which is some indicator of some degree of stability from a shareholder equity value. That price to book ratio has declined from a high of 4 times in fiscal 2019 to just around book value, or 1.1 times in fiscal 2023, again with those share price adjustments over the past few fiscal years, the absence of dividends and other factors, of course, contributing to some lack of investor confidence in NCB over the past few years. Nevertheless, when we compare NCB to the banking sector and the market book-to-book ratios on offer across the sector, we can see that it is trading at the lowest level in terms of that market-to-book ratio at 1.1 times. Scotiabank is on the opposite end, 2.6 times, for example. So at that price of $3.55, last traded price for NCB, the stock is again trading at a price to earnings ratio of 23.2 times, above the sector average of 14.7 times, and has only just begun to resume the payment of dividends with a trailing dividend yield of 0.7% compared to the banking sector average of 3.6%. Now, in its annual report, NCB targeted or announced that its target was to retain the dividend payout ratio of about 50%. So with some earnings normalization as well as some anticipated dividend normalization, resilient banking results, weaker insurance results for now, which we do expect to normalize over subsequent periods, but keeping an eye on that elevated price to earnings multiple. Bourse is going to look at their NCBFG as a recovery story and is assigning an overweight rating to NCBFG for fiscal 2024. Well, that's it for this week's edition. For more information, you can give us a call at 2BORSE or 226-8773. Email us at invest@boursefinancial.com. And of course, you can check out our website, bourseinvestment.com, where all of our research is absolutely free. And you can catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. Well, however you choose to spend your Carnival long weekend, to be safe, have an enjoyable time, and we'll see you next time on the Bourse Report.